Hey traders, Mike Sir here. In today's video, I'm going to explore a popular trading strategy that allows traders to generate profits regardless of the overall market direction. So rather than try to buy or sell an asset to go up or down in value, this approach called pair trading focuses on profiting based on the relationship between two related assets. So in this video, I'm going to tell you exactly what pair trading is, why you should or should pair trade, and help you identify suitable pairs and strategies to trade. Now, most importantly, I'll show you how to generate profits through pair trading. So let's get started. First off, let me share with you what pair trading is. Now, it's a market neutral trading strategy that seeks to profit from the price relationship between two correlated securities, regardless of the overall market direction. Now, it involves simultaneously taking a long and a short position on two correlated securities, whether it's stocks, ETFs, or even Forex. Now, the goal is to try to profit from the price difference between them rather than just trying to determine whether a particular stock would go up or go down in value. Now, the key is to find pairs that historically move together. For example, the most common type of pair trading is a Forex pair, like let's just say the Euro versus the USD, where if you are buying this particular pair, you're essentially buying the Euro to go up in value while simultaneously betting the US dollar will go down in value. Now, generally, pair traders analyze the historical price movements of the chosen pair to identify deviations from their average price difference. Now, these deviations may occur due to temporary market inefficiencies or external factors that cause one security to be stronger or weaker than the other. Most importantly, the strategy is based on the assumption that certain pairs of securities are correlated and will move in a similar manner over time due to their underlying fundamental relationship. For example, you shouldn't pair trade a security like Tesla stock with a biotech stock because there is no clear correlation between the two companies. So what's the benefit of pair trading? Well, you might be wondering why, because instead of trying to determine whether one security will go up or down, now with pair trading, you have to determine two securities' price direction. Before I share the pros and cons of pair trading, I want to let you know that this video is sponsored by GainTrade. They are a leading financial application for statistical pair arbitrage trading for the US stock market and utilizes AI to help you find the best pairs to trade. It's a smart and easy to use interface that automates the whole pair trading process. Now let me show you how. First, choose the stock or ETF that you want to trade. Then choose from various combinations of the pair that you want to trade, such as Apple versus Microsoft. Then set your risk parameters and position size to determine the number of shares of the pair that you want to trade. Then sit back and watch the bot automatically execute your pair trades along with stop loss and take profit orders. Click on the link in the description box below to sign up for a free paper trading account to create and test out your pair trading strategy today. Well, besides the clear benefit of pair trading being a market neutral strategy, meaning that you don't need to determine the overall market direction, you just need to focus on the price differences between the two securities. Now, this market neutral characteristic can be particularly attractive during periods of market volatility or uncertainty when you're unsure of the price direction, and therefore another benefit of pair trading is risk mitigation. Now, as I mentioned, if the overall stock market falls and if you are long one company stock and short another stock, the short position acts as a hedge and your risk is somewhat minimized. Lastly, one more benefit is the potential for greater profits. Now, if you're able to identify a correlated pair where one security is very strong while the other security is very weak, then the value of this pair could skyrocket in price and result in big profits for you. Now, while pair trading can be quite advantageous, there are several cons in pair trading. Now, besides the obvious one is that you need to analyze and determine the price direction of two securities versus just one. Also, pair trading can seem more complicated as you will need to identify suitable pairs, understand their historical correlation, and assess potential future divergences. Another con is if you buy an individual security like a company's stock, it has the potential to double, triple, or more in value, especially if it's loved by Wall Street. However, it's rare to see these type of returns in pair trading. Lastly, but most importantly, is when the correlation between the two securities breaks down due to various factors such as market conditions, economic events, or company-specific fundamentals, and you're unable to understand why. For those who wish to pair trade, determining which pairs to trade involves a systematic approach that combines fundamental analysis, statistical analysis, and chart analysis. Now, here are some considerations in selecting pairs for pair trading. Now, the first is to identify related securities. Look for securities that have a historical or fundamental relationship. Now, this could be companies in the same industry, or company stocks of direct competitors, or a company stock that is tied to an industry index. Now, the goal is to find pairs that tend to move in a correlated manner, but may experience temporary divergences in their prices. The second is to analyze historical correlations between the pairs. Examine the past price movements of the securities in the pair and calculate and analyze the correlation coefficient to determine the strength and the stability of their relationship over time. Now, a high correlation coefficient of, let's say, 0.80 indicates a strong relationship. The third is to look for fundamental catalysts. Now, assess the fundamental factors that may impact the pair. Consider any company-specific news, earnings, economic data, or events that could affect the securities differently. Now, any news that affects one security more significantly than the other can lead to price divergences and potential pair trading opportunities. Lastly, look for divergence opportunities. Identify periods where the pair has historically exhibited price divergences. Now, these divergences could be temporary and present opportunities for pair trading. So, analyze charts, the technical indicators, and statistical measures to identify potential entry and exit points. Let's now talk about what type of strategies are best deployed for pair trading. Well, the one that is most commonly used is when a trader identifies a correlation discrepancy. Now, this is based on historical notion that these two securities have maintained a high and stable correlation with each other, but when this correlation falters, a pairs trade can be deployed. When pairs from the trade eventually deviate, the pair trader would seek to take a long position in the underperforming security and sell short the outperforming security. If the securities return to their historical correlation, a profit is made from the convergence of the prices. For example, let's look at the correlation between Coca-Cola company stock and PepsiCo company stock. Now, as we know, these two companies are direct competitors to each other and have very similar businesses. Now, let's take a look at the chart of both companies. Here's a chart of Coca-Cola stock, and the orange line is PepsiCo stock. Now, you can see that the stock price of both companies are moving in tandem until October, where Coca-Cola stock underperforms PepsiCo stock. Now, this is where you can utilize technical analysis to find an opportunity to buy the underperforming Coca-Cola stock, and you can see that the stock hits a double bottom in December, and that would be a good opportunity to buy the stock, while at the same time short the outperforming PepsiCo stock. Now, you can see that the two stocks return to their historical correlation in the middle of February, and as a result, you would have made your profit. Another trading strategy is to identify a correlation that is about to diverge. This is where a trader will find a correlated security like a company stock that has historically moved in tandem with its sector performance. But when this correlation begins to diverge, a pairs trade can be deployed. This would involve selecting a specific company stock that you feel could outperform the sector index, which is tracked by an ETF. Once the pair diverges, the pair trader would seek to buy the outperforming company stock and sell short the sector ETF. If the company stock outperforms the overall sector, then a profit is made on the diverging prices. In addition, if the overall market or sector falls, then risk is mitigated due to the hedge on the sector ETF. For example, let's look at the correlation between the company stock Apple versus the technology index ETF XLK, which Apple has a 23% weighting in. Now here's a chart of Apple, and the orange line is the tech index ETF XLK. Now you can see that the prices of both Apple stock and XLK ETF move in tandem from the beginning of 2019 all the way to September. But then Apple's stock price begins to outperform the tech sector ETF, and this is where you would buy Apple stock while shorting the sector ETF. Now you can see that the Apple stock continues to outperform the sector ETF XLK. Thanks for watching. Please hit that like and subscribe button, and let me know in the comment section below any questions that you might have on pair trading, and I'll answer them in the box below. I'll see you all in the next video.